Hey everyone, today we've got some exciting news that got Alibaba's shares skyrocketing by 8%. That's right, its market value just increased by at least $18 million, which is a massive gain for Alibaba, considering they got slapped with nearly $1 billion fine. But hey, who wouldn't take that trade-off, right? For Analyst investors, it is definitely a good news. This is the end of the mandatory rectification phase, and it's a sign that Analyst re-recognition and spin-off can move forward with a lighter step. So we can see that the hardest part for Ant Group has already over, and they can start thinking about going public again. So let's break it down and see what got Ant Group in trouble in the first place. The main issue of it is some shady fund management. Now we know that Chinese internet product and tech innovations often comes from bending the rules, and Ant Group's financial innovation is no exception. But it is super important to keep things in check with strong regulations. Remember, it's all about balanced, run, compliant innovation that doesn't put consumers at risk. As we all know, both Didi and Meituan have bounced back from their lows and now thriving as China's biggest flexible employment platforms, whichever had similar experience with the Ant Group. And here's some crucial micro news I want to share with you. By the way, I'm a stock analyst based in China, and I'm also trading stocks. My goal is giving the investors a different view to look at the Chinese concept stock. If you don't want to miss the quality stock analysis videos, don't forget to follow my channel now. Let's go. A big secret is that July is always a big deal for China's economy, setting the stage for the second half of the year. Just yesterday, the State Council brought in 8 economic experts for a symposium. Looking at their past stances, they're eager to give the platform economy a chance to grow within the rules, making it a key player in the economic recovery. Although the comparative economic data from the second quarter looks good, the overall manufacturing and employment situation hasn't really improved. So, for the rest of the year and into next year, government needs to put more resources and focus on the economy. That's where the platform economy comes in, driving consumption and employment, and powering up the economy without internet conflict. And I will give you the scoop on what's been happening with China and U.S. Treasury Secretary Yellen. So it looks like Yellen recently visited China to talk about RMB exchange rate, and things seem to be looking up. In fact, after her trip, she held a press conference in Beijing to sum up her visit, and she said that her meeting with top Chinese officials were direct and productive. Plus, she made it clear that the United States is not trying to decouple from China's economy, which is great news for both countries. This could also be good for the market and related sectors like semiconductors. Now let's talk about Alibaba again. The company has been on the up and up lately, with many major international banks expecting considerable growth in the second quarter of this year. Morgan Stanley even published a research report that said Alibaba's core business, international business, China services, and local services are all driving the company's recovery. They expect Ali's China retail commercial custom management, the adjusted EBITDA, to grow 4.4% and 18% year-over-year, respectively. Morgan Stanley reiterated Alibaba as a top pick with a hold rating and a $150 price target. So things are looking pretty promising for Alibaba recently. But before we get too excited, let me tell you why you should still be cautious. When it comes to a big bull market for Chinese stocks, there are usually 3 conditions that need to be met. First, China's economy needs to be strong or at least policy-friendly. Second, U.S. interest rates need to be falling. And third, U.S. and China relationships need to be good. In the past, when two or more of these conditions were met, we saw that Hong Kong stocks and Chinese concept tech giants achieved positive annual returns. So are these conditions being met right now? Well, China's economic recovery is about, I think it's just an average level. The probability of U.S. interest rates falling this year is relatively small. And when it comes to China and U.S. relationships, it's hard to see. I just cannot give a very optimistic view on it. So while the short-term win rate may be not very high, the odds of Chinese stocks are still good. And let's be real, they are relatively cheap compared to other assets. In fact, the net cash on hand or cash minus short-term debts of mid-cap stocks is more than 10% of market capitalization, and some companies can even reach 20%. Tencent may be an exception. While they have a smaller percentage of net cash on hand, they have a large amount of equity assets on hand, which accounts for about 25% of the market capitalization. Overall, the balance sheets of Chinese concept stocks are generally very healthy, with a large amount of hardcore assets on hand, which makes market capitalization look relatively low. Now let's take a look at earnings. We're using the concept of free cash flow here, which you can think of as net profit, but a bit more tangible. The PE ratio of major mid-cap stocks are around 5 to 20 times, with an average of something like 15 times. I think that's a conservative estimate compared to growth stocks in the stock market, which can usually give a PE ratio of 20 to 30 times, and the value stocks which give 5 to 10 times. Finally, let's talk about shareholder returns. Chinese stocks don't usually pay out many cash dividends, but many companies have buyback plans of 60% or more of their current market capitalization. For example, Tencent's buyback is particularly fierce. They buy back about 50 billion a year, and if the share price continues to be at a super low level, they would buy back nearly 100 billion a year. So, disregarding the one-time dividend, Tencent's dividend yield, include buybacks, is currently around 2%, which is not low. Overall, the market is giving relatively low valuation to mid-cap stocks, which could be a great opportunity for investors looking to get in a good price. So keep these factors in mind when making your investment decisions. There you have it, folks. Early success is promising, but there are still some factors to consider before diving headfirst. Stay cautious and keep these conditions in mind when making your investment decision. The last but not the least, let's talk about the importance of AI concept when it comes to Chinese concept stocks. Whether it's US or A-share stocks, as long as there's a connection to AI, it can push some valuation. Even if it's not a big rise, it can still be a small rise. And let's be real, industries related to AI like computers, media, or games can't bypass Chinese stocks. However, the valuation of Chinese stocks hasn't improved much in this regard. So what's play here? Well, from this perspective, the odds are higher for mid-cap stocks. There's not much room for downside, but there's room for upside. However, combining the win rate and odds, we shouldn't expect too much in the short term for the mid-cap stocks right now. It's more rational to have patience and let it raise slowly and orderly back up.